This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart deck, because something a lot of people have been wondering for a long time is how long can rising real interest rates drag the price of gold down before people wake up to what I think is obvious, which is inflation's coming, guys. The title of the chart deck is Time for Gold, or Time for Gold ? Is it time for gold? Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button that says Looking for the Downloads immediately above Jesse Felder's picture. Patrick, what do we have here? It says, is it time for gold? And then on the very first page, we've got the S&P 500.
Well, we're going to just go through the markets just for a quick update, and then we'll talk gold at the end of the chart deck. So just a quick update on the S&P 500, which is now extended up towards that 4,100. This is actually a very critical moment for the S&P. There's a couple of these targets that we had up here as we approach 4,100. And when we look at it, the Nasdaq is slowly approaching its previous high, which could act as an overhead resistance. And so while the trend is very much still upwards, this is actually a really important moment in the markets. And when we go to page 3, when we look at that Russell 2000 small cap, what was particularly interesting is the fact that the small caps have actually not participated in this leg of the rally. And this is really interesting because the Russell has actually been one of the leadership indexes from the November lows. And we've really now seen that transition a little bit. There are some technicians out there that are trying to cookie cutter that head and shoulders topping formation potentially forming on the Russell. I think it's a little early to be all in that camp, but certainly the underperformance of the Russell is something we can't ignore. And what's particularly interesting about that is on page 4, when we have the ratio of the Russell over the Nasdaq, the Russell outperforming the Nasdaq has really been the trend in place, largely driven by yields. And so when yields were skyrocketing higher, we saw all that money flow heading into small caps, cyclicals, and financials. And really those FANG stocks and many technology names were dragging in that period. But since that March 18th low in yields, we have actually seen this trend shift. And really the question I have in the back of my mind is, have we seen sort of that reflation impulse that's driven those sectors and those parts of the stock market that have outperformed? Have we seen a transition point where that is now stalled and we're going to go back to what's worked, back in 2019? And that's going to be really interesting as this develops.
Let's move on to page 5. Bitcoin hasn't quite broken out above 60,000 yet. Remember when 30,000 was a really big deal, like
it was
a month ago?
No, it was, and what's interesting here is that there was some chatter on the internet and on Twitter about the idea that Bitcoin could be topping, or something it's at least we can say that it's running out of momentum, because it certainly has not been making higher highs over the last couple months. But I still don't think that there is any real structural technical damage other than those divergences in momentum. And the way I'm looking at this here is that if we can see Bitcoin still hold above that kind of 53 to 55,000, we still have to give the bulls the benefit of the doubt that they're in control of this market and they could still impulse it up to 70,000. But this is actually a really critical moment, because the more divergence you have in the loss of momentum, the more likely it is that the bulls will drop the ball here. And I'm not predicting that they will, but this is a moment where we have to watch very, very closely as to whether or not the bulls can really take this off to new highs.
Well, Patrick, I had to laugh as I looked at page 6. You've got the chart that I sent you on the left, and you've got your own big picture trading chart on the right. You didn't title this decluttered version of Eric's chart, but I know our listeners are thinking that.
I mean, all we really wanted to do is just show where we stand on oil. And one of the things that you were illustrating here, I'm not going to put words in your mouth, I'll let you explain it there. But I mean, the question here is if the 50-day doesn't hold, how deep can this correction go? The one thing in my mind is that I think that while I remain bigger picture bullish crude, my spidey senses are just like that there's room for this still to be a little bit deeper. And I know you had some lower targets. What's on your mind?
Well, Patrick, great minds think alike again. Now, it is possible that this is ending and that we've seen the bottom and that it's all going to get better from here. But frankly, if you look at the chart on the left, look at that yellow trend line that we've stayed neatly below without even testing it once. Look at the fact that we've really taken out even the 55-day moving averages, which are the red ones at the bottom, on an intraday basis with some significant moves below them. All these things say to me that maybe there's more downside still to come here. The test is going to be if the current low at 57.25 holds or not. We could get another retest of that level, maybe even just a little bit lower than that level to shake out the weak hands, and that could be the bottom. But if you see 57 getting taken out to the downside with any kind of momentum behind it, it says to me that this level broke and that we're headed to the next level down. So where is that next level? Well, look at the one significant consolidation that we've had in the middle of this rally since the beginning of November. And it's in the month of January, and it happened right around the 200-week moving average, which is now 53.48. That's circled in the red oval on the left side. It's also conveniently just about $1 below the 38.2% retrace level, or I guess the other way you could say it is it's halfway between the 38.2 and the 50% Fibonacci retrace level of the entire move up from November to the beginning of March. So, if I had to guess what happens next, maybe this holds. And the reason I say maybe it holds is every other time in the course of this rally that I've thought we were going to have a major correction, it turned out to be shorter lived and less downside than I expected. I think this one might be different. If it is different, where we go down to probably is around 53.50. I would be surprised if the gods of OPEC let it go much lower than that. And you've got a whole bunch of support there, whether it be the January highs, which were resistance then that become support now, whether it becomes that 200-week moving average, which is pretty stable there at 53.50, if it's the 100-day moving average, which is rapidly increasing through 53.86 right now. Big cluster of support there. I think that's probably where it goes. The next big cluster of support after that doesn't come until $48 or so. I don't think we're going that low. I don't think OPEC will let it go that low. So that's a range of possibility. If we do get 53.50, I will be buying and adding to my long positions in size. I think that's a tremendous buying opportunity if we get it.
It's funny that's the very levels that I'm thinking as well. I mean, the 50% retracement's down around 52, but that consolidation, 53.50 area, would certainly be a place where if the 50-day doesn't hold, that things could get washed out down to that level. But like you were saying, I think that would be a really interesting level to test out as a buy on dip. And so let's see whether the market gives it to us. But what's interesting is I wanted to go on page 7 and look at the energy ETF, which is the energy companies themselves. This is using that SPDR ETF to XLE. And what's interesting is we're consolidating along the 50-day moving average on this one as well. And we're at that same kind of a juncture. And what's interesting here is that if we did see that break on crude oil to take and test that next little level lower, this could send the XLE down toward that kind of 44, 45 level where the highs were coming in back in January. And that will also be a point of high interest for me in terms of whether or not a buy on dip would emerge there if we had a quick washout down to that level. I know Jesse was talking about these energy companies, but after such an extraordinary run, really waiting for a buy on dip was the only really sound strategy to do. But the big question is the buy on dip here now, or is it going a little bit lower? And that's something that I'm going to be watching in the days and weeks to come.
Let's move on to copper futures on page 8. What do you see going on here?
Well, I didn't draw the trend line in there like you had there on crude oil, but you can basically connect those highs from February and mid-March and realize that earlier this week we had a breakout attempt on copper to break to the upside. And so far, the bulls have dug in and are relatively consolidating well in this breakout. It's going to be really interesting to see whether that 50-day moving average ends up having held up this and potentially the start of another bull advance in copper. And that's going to be interesting because naturally would think that the commodities trade would all sort of correlate, and maybe copper, if it's breaking higher, is a sign that maybe crude oil won't be as deep of a correction. Who knows? I don't know if I want to overread into that correlation, but certainly the consolidation on both copper and oil started roughly in the same window, and it'll be interesting to see with coppers leading the way out of the consolidation.
Let's move on to gold on page 9. This one, boy, we've been well below that 50-day moving average ever since January or so, but we're right on the edge. What do you think is going to happen next?
Well, the one thing, interesting thing is, let's go back to what we saw at the start of March, right? And there was this big washout in late February and the first week of March that basically saw gold heading down to 1675. And as always, there tends to be some form of a oversold reflexive bounce higher. And during that entire rally throughout the middle of March, there's no other way to classify. It was pretty pathetic. Like they had no follow through. It was very shallow. And there was nothing really positive to say about gold during that bounce. Then when it rolled over and headed back down, that was the true test. And when gold at the end of March headed right back to retest that low at 1675, that was truly, in my mind, the break it or make it moment for that. Because if we gave out 1675, that was a real no man's land under that support. I mean, we had Ole Hansen talking about the significance of that level. There's a lot of really smart people that were watching that as a level. And the fact that gold was able to reverse and with some more meaningful velocity off of a retest of a key support line is the first positive thing we've seen in gold in a while. And we're slowly approaching retracement levels, moving average levels. There's a lot of work for gold to still do to start repairing the chart. But this is the first positive sign we've seen in gold in a long time.
I couldn't agree more, Patrick. If I just look at this chart, the last time I see a 1 week or 2 week rally that looks this exuberant, I've got to go back to last year in early December to find, this kind of pronounced upward movement. And it turned out that was a spirited rally that took us up to the beginning of what actually was this unwinding. So it's going to be very interesting to see where it goes from here. In the big picture, grand scheme of things, I think the secular inflation story is very real. The price of copper has more than doubled since it bottomed in March. I think the price of gold is going to more than double before this is over, and I'm certainly not predicting that tomorrow or next week. But it's going to be very interesting to see if this is the bottom or not, Patrick. And I think that answer is going to hinge entirely on whether or not we've seen a short-term top in U.S. Treasury yields. But let's move on to chart 10, a golden wall of worry.
So when we're looking at this chart, it was an interesting one that was on Twitter, and it was basically showing the gold newsletter sentiment index and just how negative things have gotten. I mean, we're at basically 2-year lows in terms of sentiment toward gold mining stocks. And that's also another kind of red flag for me in terms of the fact that sentiment has gotten so negative that often these are the things that are associated with bottoms and key turns. And so it's really interesting to see that at the same time as we're seeing gold creating some key tests of support lines and starting to try to roll up, really the sentiment couldn't be more negative.
Let's move on to page 11. Now, as much as we have not yet seen any real breakout through the moving averages on bullion, we do see it on the gold miners ETF.
That's right. What's particularly interesting to me about the gold miners is the fact that in the month of March, we saw silver break to a fresh monthly low. We saw gold go and retest its low. But during that time, the sell-off that we saw on the tail end of March in the gold miners did not go and retest their lows. It actually never really accelerated to the downside, almost like the selling has all been exhausted already. And as soon as there was some reaction in gold and silver off of their lows, the miners were very quick to break out above that moving average. And I've seen this in the past where a lot of traders that believe it's a key turn point in the markets will act first on the miners before we start seeing it on the precious metals themselves. And we've seen that in the past where we've seen the constructive price action emerge in this space first. And the fact that we're seeing this starting to turn up is certainly got my interest.
Now, Patrick, you're doing a special webinar exclusively for your Big Picture Trading members titled The Best Gold Buying Opportunity We've Seen in Years. What are you going to be covering? Tell us more about it.
Sure, Eric. I do believe it's the time to act. So back in 2018 and 19, I presented at the VRIC and shared with our MacroVoice listeners the way we approach commodity cycles and how we use options to position ourselves both to manage the risk and to leverage returns. We are now approaching the right duration and depth of the down cycle, and I believe this is the opportunity to act right here. During the webinar, I'm going to be going through the analysis and execution of how to get in now and maximize on the upside potential and while minimizing that downside risk. And so I'm inviting all MacroVoice listeners to join me to this free webinar. All you have to do is sign up for a free trial to bigpicturetrading.com, and you'll get access to this webinar. Now, even if you've had a free trial before, you'll be able to sign up once again. So I look forward to seeing everyone online for what I think is the best gold buying opportunity that we've seen in years.
Patrick, when is the webinar being held?
It's going to be held on Friday, April 16th at 9:45 a.m. But to those that can't attend it live, the recording will be made immediately available after the live event.
And, of course, there's information on page 13 of the slide deck that tells you how to sign up, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.